Thanks, John. Can you all hear me without the microphone? Before I get into the slides, it took me a little while to recognize that issue of lifestyle businesses. And I've pulled some numbers at one point. 98% of entrepreneurial enterprises are not appropriate for these types of investments, right? These are built to be sold. And it's very understandable that many entrepreneurs are looking to build to run and to cash flow over time. And you'd like to find a way to be a helpful capital source, but it just doesn't fit. So, you learn over time that it's got to fit that particular mold, which is only a sliver of entrepreneurial activity out there. I'll try to blow through these because basically the way I think we can think about it is we want everything that he just said plus more proof. There's nothing that he's looking for that we're not also looking for, and I think we've heard this issue of too many individual investors with rights. Once we get involved in a situation, as Tony said, 70 companies, only one of them got by with one round of financing. Right? There's always something happen. There's a need for decision making, and you can't be in a position where you have to go herd a lot of cats in order to make a decision. We insist that it is pretty limited, and that there's a shareholder rights agreement that everybody has to sign that says, hey, if these three people or these three entities decide we're going to do something, you have to go along. You're contractually committed to that because, again, simplicity allows for flexibility and effectiveness. Valuation expectations. That's about the fifth time you've heard this in 10 minutes. We've done 110 investments, and so we've got, it's not terribly precise, but rules of thumb that get you within a range pretty quickly. And so we're going to know whether you're willing to live with that range or you're not. Exit expectations, again, same kind of thing, but you really need to line that out. I mean, there may be some situations like the bank service company that, $20 million exit, the investors are going to do well and they're going to want that. If up front the entrepreneur says, go big or go home, we're building a $100 million company here, if you're not aligned, you're going to be at odds in the future, and you can't and don't want to hope that things will work themselves out over time. You want as much alignment as possible up front, because chances are things will come up that are divergent and that you need to work through. And so, not only do you want alignment, you want a lot of transparency and trust so that you can work through the issues that will inevitably come up. Board composition. 6 angel investors may be in the deal and 4 of them are on the board and they really like being on the board. We're going to want an independent board. And we recognize with some humility that a bunch of financial investors aren't the best group of advisors for the company. We want industry people there as well, and so you might get yourself into a position where, okay, it's fine to have one of those original angel investors continue to represent the significant interest of the group, but we're going to want to limit that and then expand industry expertise if possible. The last point is everything's negotiable. It really depends upon how attractive we view the opportunity that's out there. We're willing to stretch a little bit here and a little bit there, and okay, you can have 2 of those board seats, or yeah, we'll give you a 20% higher valuation maybe if you trade off with a little bit of preference. It's a pretty open-ended process when you get into it, but it's a lot more efficient for us these days because we know what our boundaries are on that pretty well. John spoke a little bit about features and terms. We base what we're willing to pay on what we think the outcome is going to be. Are we going to build a $10 million company that's worth 10 or 15 and we need to make 3 times our money because we think it's fairly low risk? Or are we leading a $10 million round, but we think this company's going to require $30 million to get to a $150 million exit? Well, let's start with that 150. If we think once we build it, it can be bought for that, and then back into what's required because we know there's going to be dilution from future rounds. And so we think about it in that respect. So you start with the end in mind. You also start with the beginning in mind as well. We are typically paying for software as a service companies and medical device companies 3 to maybe 5 or 6 times their revenue rate. And there's nothing magical there. It's just that we're not going to pay a $20 million valuation for a $1 million company, even if everybody's expectation is this is going to become a $50 million company. We're just not going there. The revenue is a decent proxy for how much proof you have that the business model's working. And so we might stretch, but we're not going to stretch too far. Certainly Series A investors will often get involved in sub $1 million of revenue. We're probably looking for a minimum of 3 to 5 million of revenue before, as a expansion stage investor, we would come in. Seniority with dividends and participation. So, the last money in is always the first money out. And that last money in comes out first with an accrued dividend, typically not paid current because the company needs the cash. And we're not interested in current cash flow, but we want some return off the top and then typically a sharing of the equity after we get our return. So it oftentimes looks like we're getting debt return plus we own the equity. That's called a participating preferred. Oftentimes we'll say, well, that goes away after we've made 4 times our money or 5 times our money. But oftentimes it doesn't go away. It's just the relative risk reward that we see in the deal. And then redemption. We didn't used to always have this, but basically, because over those 100 and some deals, we have a 10-year fund life. Sure, you guys have a fund life, and at some point, you just have to get out. It's our fiduciary responsibility to our investors. So we put some teeth in there that at some point we get to pull the trigger. We can go we've gone as long as 7 years, but at some point we have to be able to say, look, even if you want to keep going, we have to be able to get out. We can either force the sale of the company or we get to redeem at fair market value, and if you can't redeem us, then the company has to be sold. And so that's often a big sticking point with the entrepreneur who says, well, I don't know, I might, if this is working, I want to run this thing forever. And in certain circumstances, we've been flexible to say, well, then you got to get somebody to step into our shoes to buy us out at the fair price. We're not looking to cap your opportunity, but that's the contract. That's the bargain you made up front, and we got to be pretty clear about that. So this thing I talked about in terms of proof, our best source of diligence is real customers that have paid real money for the solution, whatever that solution is. How do they express the priority of the pain point that this solution addresses? How did they used to solve the problem before they bought this particular one? What was their buying process? What other alternatives did they look at, were they aware of, and how did they become aware of those things? And then why did they make this decision? What differentiated the product. I mean, it's pretty simple stuff, but unless you can access a pretty good group of folks who have gone through this engagement process with the company, it's hard to know. You know, we did a fair amount of earlier stage investing earlier in our fund lives, in funds 1, 2, and a little bit in 3, and boy, you know, thing made all the sense in the world. And so we're like, well, yeah, that's going to work. And we would even go talk to prospective customers, like, well, would you buy this? Oh, yeah. Would you pay this? Sure, we would. But then when it comes to the actual market engagement, well, yeah, that person would, but the person who signs off on it wouldn't. You know, it's got to go through the marketing department, or it's got to go through the IT department, or it's, you know, what is all of the nuance of the process that gets that product or service sold. Operational diligence is the next level. You know, do you really have these kind of gross margins? What is your cost structure? How efficiently can you reach the marketplace? We really focus on cost of customer acquisition, because when you're scaling an enterprise, that's really what you're doing. You're just trying to sell more of the same thing. And have you proven that you can access the market? You can develop awareness, you can develop trial, and oftentimes, you know, these days, these companies, it's a lot of online marketing, it's a lot of inside sales, and yeah, there's metrics with that stuff. And it's not going to be perfect at this stage, but there have to be some proof points in there that it's working. Because if you spent $1 million on sales efforts and marketing efforts last year, and you gained 200 grand of recurring revenue at 50% margin, well, that's a 10% return, right? You put up $1 million and you got back 100 grand recurring, which, you know, it's a return, but it doesn't make it over the hurdle. You know, we're looking for, we'd really like to see 100% ROI on sales and marketing efforts. Depending upon how mature the situation is, we'll settle for as low as 50%. But, you know, there's other costs to run the business too. There's G&A and overhead, and so you have to get comfortable with that stuff. And the more mature the situation, the easier it is, the more stuff you can get your arms around, which, you know, that just is what it is. You all have to do a lot more extrapolating. But even when you have a lot more information, it can still be a tough decision. I think this was yours. It just got back in there. So, you know, some things that we look at, because we've done a lot of investments ourselves, and then we look at the research of the companies that get public. You know, when these companies were in the 5 to 15 million revenue range, what did their payback on sales and marketing look like? You know, what is reasonable? And this is expressed in months as opposed to ROI, but it's the same thing. If it pays back in 12 months, that's 100% ROI, right? The money you put out came back to you in a year, that's 100%. So 12 months is 100%. You see here, the median of the successful companies is 24, which implies a 50% rate of return on the sales and marketing efforts. And, you know, that should get a little bit better as you scale, but it kind of holds in that consistent range. And if you're at 50 or 60 months, you know, you got to have something pretty compelling to make us believe that it's going to be different going forward.